We're seeing more and more cash offers made on homes, but is paying for cash actually better? Are there downsides to paying in cash? Everybody wants to be debt free, right? If they can, but is it still smart to get a mortgage? We're going to break that down with Bill Litton at Cross Country Mortgage coming up. Welcome into the Smart Mortgage Show. Ben George with Bill Litton, Regional President at Cross Country Mortgage. Find us online at smartmortgageshow.com. Bill, we're talking about cash today, and cash is always king, right? But I want to kind of get into this idea because I think on paper, everybody would say, well, I'd love to pay for cash and have my home paid for, but there are a lot of things to be thinking about before you make that decision, right?
Yeah, I think that the old adage years ago, and mortgages aren't a super old concept, right? The availability of mortgages in the last 100 years is a new phenomenon. So the amount of interest that you pay back on the mortgage is concerning. It is a lot, but I think the old adage was pay off your mortgage, and my parents, pay it off as quickly as you can and get it out of your life. But I think there's a more modern, maybe even a slightly more advanced strategy that says maybe paying off your mortgage in full is not the best thing. There are other options.
We're going to get into some of those considerations here over the course of this video, but I just want to start, Bill, first with why does cash feel good, right? Why is it something that people want to do? It's probably more of an emotional thing, right?
Yeah, I think you hit the nail on the head, Ben. Is emotionally, it can feel really good to have no mortgage debt. And by the way, to pay in full the cost of a home, which is an appreciating asset, it is not necessarily a bad financial decision. In fact, it can be a really good financial decision. And it's a guaranteed certainty when you do that. You eliminate the mortgage interest, and it is a certainty. But, we also see what we would call someone being, house rich and cash poor. Once you put all of the money into the house, now it's in there and it's harder to get it back out. So maybe there's a strategy that kind of helps you, straddle both and be a little bit more diversified.
All right, let's talk about the first thing to consider then, because I know we've done some videos on this before, Bill, but the opportunity cost, right, of paying all cash for a home. So explain how that works and kind of what the math looks like.
So if you were to buy, let's just say a $500,000 house, okay, now the money, the $500,000 does not have the opportunity to grow in the market. So it is now growing at the rate of whatever the local real estate grows at. Okay, so let's just say that that's 3% per year. Okay, so again, not a bad use of your $500,000. It's an appreciating asset. It is going to increase at 3% per year. But what if you were to put 20% down on the house and take on a $400,000 house, take $100,000 and put it down, and take $400,000 and now put that into an S&P fund, historically ranging returns of 7 to 10%. Now we've kind of spread out and diversified. Some of the money is in the house, some of the money is in the market. And, you can really, over time, see how that strategy has much greater wealth building benefits for sure.
Yeah. And I think this conversation obviously comes up more now than it did. I guess when the rates were lower, right? I mean, it made more sense to stay invested because it's easier to outperform 2 or 3%. Now to 6 or 7, right? It makes you think a little bit more, but there is still an opportunity cost there, especially if you look at the S&P 500's performance recently and just look at the markets. If you are an investor, you understand that. So something to keep in mind there. The first point there is that opportunity cost.
Yeah, Ben,
the second point, did you want to add something?
Yeah, I just want to add really quick. I'm sorry. If you take a compound interest calculator, right? Do a little bit of an experiment, and you put in that $400,000, and you put in an interest rate of, and I'm going to say, let's go, relatively conservative for the S&P. If you put 400,000 in and you don't add any more money at all, just the initial investment over 30 years at 8% compounding, The end of 30 years, that's worth $4 million. That is a substantial increase in, you won't get that same return on the real estate over that period of time. So I love looking at the actual numbers because it really tells the story.
Yeah, it does. And again, this is something you can work with the lending team and cross country mortgage to kind of better understand. And I want to get to the second point, Bill, is the liquidity trap. I mean, this is a big thing to remember here too. Is hey, yeah, it's great, and it just kind of goes to paying off your mortgage too. Yeah, it's great if you have that option, and you might be able to benefit from being debt free. But you have to remember there is that emergency liquidity trap that you could fall into.
Yeah, and when I think of cash as king, I think of having the cash available and not tied up. Now, if you put it all into the house, you can get it out, but now you've got to refinance or you've got to, use a home equity loan, and those things aren't guaranteed that you'll qualify. The availability of those change over time just due to market conditions and underwriting. But most of the time, let's say you would be able to do it. It's still, there's a cost involved. There's time, energy, and effort. If you have a medical emergency, you can't sell your kitchen sink to pay for it, right? You're much. I think being liquid is really the better play here. So accessing cash later can be expensive, and there's a timing requirement with it. It's not available immediately. So again, I think having some sort of put enough money down on the house to get the best financing terms and not have PMI, put 20% down, but be diversified where you've also got money in the market.
Yeah, I like the point that you're thinking of cash as king means having access to cash, right? So again, something to kind of keep in mind there, that liquidity, you want to have that access to that in case something comes up. And look, honest truth is life always throws us curveballs, right? So you want to be prepared. Third point to keep in mind, Bill, taxes. So this and the inflation hedge, which I think oftentimes goes overlooked.
Yeah, I think as far as taxes are concerned, there are tax benefits to pay mortgage interest. You can write them off, and depending on the price point that you're at and the amount you're borrowing, the standard deduction is quite large at this point. So a lot of people don't itemize, but for people that are paying more interest and people that are paying more in real estate taxes, which also go into those itemized deduction calculations, you can certainly realize some tax breaks by having a mortgage. So that is really important and valuable. You can't do that if you're never going to get there if you don't have a mortgage to add into the itemized deductions. Also basically a mortgage also is a hedge against inflation. So you're paying back the bank with cheaper dollars 10 or 20 years from now, while the home value is increasing. So with cash, you lose that leverage. So I think that's also really important to realize, is that over time, you're going to put a mortgage payment in place that meets your current budget and your current income level. Most people earn more over time. So that mortgage payment essentially stays the same. The house is increasing in value. Your earning potential is increasing. So the payment's easier to make and fitting into your budget more easily as well. So it's a hedge against future inflation.
Yeah, I think that's something people don't oftentimes take into account, right? And I think we've seen how much inflation can matter over these last 5 years or so. So something to think about there. So, Bill, anybody in this situation here that is considering a cash offer and maybe it comes into you and says, okay, Bill, I want to talk to Cross Country Mortgage about the opportunity, the options that I have at my disposal. I'm probably going to pay cash, but what are some other considerations or some strategies that you might recommend? What would you say to someone in that position?
Well, I would say number one, especially in the state of Pennsylvania, there is an option in the real estate contract where you can make a cash offer, but also indicate that you might get a mortgage. You have the strength of the cash offer, but you still get a mortgage and you go to the settlement table with a mortgage. So therefore, you don't lose any of your leverage in the strength of your offer, and you don't also lose these investment opportunities that we're talking about. The other option too is, we can fully underwrite the loan and make really strong offers that will compete with cash. So cash doesn't always win out, especially if they have a lot of confidence in the lender, if they're a known entity, if they, are known to always deliver, which our company does. There's other great companies out there that do as well. Another reason to not tie up all of your cash. Now, you could go to settlement using cash and then pull it out later as well. Some people will refinance and pull the cash back out. The only downside of that is you are paying some of the closing costs twice, as well as it's considered a cash out refinance and the rate's a little bit higher. But it does have the effect of giving you your cash back to better your liquid cash position after settlement.
Well, I would recommend probably having a conversation with a lender just to see, again, getting some thoughts like this from a trusted lender like Bill and the team there at Cross Country Mortgage can help you make that decision a little bit clearer, right? To understand your options, right? To make sure you're doing what kind of fits within your overall financial goals, right? Your financial picture. I think that's so important to take into account. So hopefully this conversation gives you a few things to think about. But if you want to talk to Bill, text the word LEND to 21,000. You can begin that process with the team there at Cross Country Mortgage. Also, please subscribe to the channel. If you haven't done that already, we'd appreciate that support as well as we continue to grow the show. So that'll do it for us here on the Smart Mortgage Show. Bill, thanks as always for breaking it down for us. We'll talk to you again soon.
Thanks so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.